As the market session unfolds, BigBear.ai Holdings, trading under the ticker BBAI, is currently priced at $6.80 per share, reflecting a notable intraday decline of 3.95% or $0.28. While many investors are drawn to the compelling narrative of a company at the intersection of artificial intelligence and national security, today's price action reveals a deeper, more complex reality that the surface-level story often misses. The stock opened at $6.81, briefly touched a high of $7 in the opening minutes, and was then met with significant selling pressure, driving it down to a low of $6.71. This pattern, a quick pop followed by a sustained fade, isn't a sign of strength. It's indicative of market participants using any early optimism as an opportunity to exit positions, suggesting a prevailing bearish sentiment that overpowers the initial buying interest. This subtle intraday behavior is far more telling than any press release and points to an ongoing battle between the company's ambitious vision and its current financial execution. The general belief surrounding BigBear.ai is that it's a specialized, high-growth player poised to capture a significant share of the expanding government and defense technology budget. The expectation is that its AI-driven decision intelligence platforms are indispensable tools for the military and intelligence communities, creating a formidable competitive moat built on security clearances and long-term, sticky government contracts. Investors often view it as a smaller, more agile version of larger defense tech incumbents, capable of rapid innovation and growth. This narrative paints a picture of a company on a clear upward trajectory, fueled by geopolitical necessity and the unstoppable advance of artificial intelligence. However, the reality presented by the market data and the company's financials tells a story of significant risk and operational hurdles. The fact that the company's P/E ratio is not applicable, as indicated by the dash in its market summary, immediately signals that it is not currently profitable. This is a critical detail that contrasts sharply with the expectation of a thriving enterprise. For a company so deeply embedded in what should be lucrative government work, the lack of profitability raises serious questions about its margins, operational efficiency, and the true cost of acquiring and servicing its contracts. The stock's performance today seems to be a reflection of this underlying fragility, where the market is less focused on the long-term AI promise and more concerned with the short-term path to sustainable financial health. This brings us to a crucial element that many retail investors may overlook: the significant short seller interest in BigBear.ai. A company with a powerful story but weak current financials is a prime target for bearish bets. The consistent pressure we see on the stock, especially after minor rallies, is often exacerbated by short sellers adding to their positions. Short interest, which represents the percentage of a company's shares that have been sold short by investors betting on a price decline, is likely elevated for BBAI. This isn't just random market noise. It's a calculated stance by institutional players who have conducted their own analysis and concluded that the company is overvalued relative to its prospects. Their thesis may be built on several pillars: the risk of contract concentration with a few government agencies, the potential for budget cuts or shifts in government spending priorities, and intense competition from both large defense contractors and major tech companies who are all aggressively pushing their own AI solutions to the public sector. For any investor in BigBear.ai, understanding how to track this activity is not optional, it's essential. You can find short interest data on financial websites like Yahoo Finance, MarketWatch, or through specialized services like Ortex and Fintel, which often provide more granular detail. One key metric to watch is the borrow rate, or the fee that short sellers must pay to borrow shares. A spike in the borrow rate indicates high demand for shares to short, signaling that bearish sentiment is intensifying. Another critical figure is the days to cover, which is calculated by dividing the number of shares sold short by the average daily trading volume. A high days to cover ratio, say over 5 or 6 days, implies it would take a long time for short sellers to buy back their shares to close their positions. While this can sometimes create the conditions for a short squeeze if good news hits, it more directly reflects a deeply entrenched bearish conviction. What's your take on the rising short interest that often follows stocks like BBAI? Is it smart money identifying genuine flaws, or coordinated pressure to drive down the price? The presence of a significant short position acts as a constant headwind, meaning the company not only has to perform well, but must dramatically exceed expectations to force these bears to retreat and trigger a sustained upward move in the stock price. Looking closer at what BigBear.ai actually does, the company provides data analytics and AI-powered solutions designed to help organizations make complex decisions more effectively. Their primary clients are within the U.S. federal government, including the Department of Defense and the intelligence community. They work on projects involving logistics, cybersecurity, and predictive intelligence. Their business model is built on securing large, often multi-year contracts. This provides a degree of revenue visibility, but also creates immense concentration risk. The loss or delay of a single major contract could have a disproportionate impact on its financial results. This is a far cry from a software as a service, or SaaS, model with thousands of diverse customers. The company's history, born from a SPAC merger, also adds a layer of complexity. Many companies that have gone public via SPACs have experienced extreme volatility, and BigBear.ai is no exception, as evidenced by its vast 52-week range, stretching from a low of $1.51 to a high of $10.36. This kind of volatility is a double-edged sword. It offers the potential for spectacular gains, but also exposes investors to the risk of severe and rapid losses. The recent stock movement must be viewed within the context of the broader market. Technology and growth stocks have been particularly sensitive to macroeconomic factors like interest rates and inflation. When the economic outlook is uncertain, investors tend to shy away from speculative, non-profitable companies in favor of safer, more established enterprises. BigBear.ai, despite its critical government work, falls squarely into that speculative category for most institutional portfolio managers. The intraday drop of nearly 4% could be part of a broader sector rotation away from risk, or it could be a response to a specific piece of news that has made the market reevaluate the company's near-term prospects. Without a major company-specific catalyst, the stock is largely at the mercy of sector-wide sentiment and the technical pressures created by its own chart and the ever-present short sellers. Comment below if you believe BigBear.ai's government contracts provide a strong enough moat to justify its valuation despite the current lack of profitability. Looking ahead, the future for BigBear.ai presents a landscape of both significant opportunity and substantial risk. The bullish scenario hinges on the company's ability to execute flawlessly. This would involve winning new, large-scale government contracts, successfully expanding its footprint in the commercial sector to diversify its revenue, and most importantly, demonstrating a clear and credible path to profitability. If BigBear.ai can announce a major contract win that significantly boosts its revenue backlog or post an earnings report that shows improving margins, it could trigger a powerful rally and force a squeeze on the short sellers. The technology and the need for it are real. The question is whether BigBear.ai can convert that need into a profitable and sustainable business model at a scale that justifies a higher valuation. Conversely, the bearish scenario is equally plausible. The risks are numerous. Competition is fierce and growing. Tech giants like Amazon, Microsoft, and Google are aggressively pursuing government cloud and AI contracts, leveraging their immense scale and resources. Large defense incumbents like Lockheed Martin and Northrop Grumman are also investing heavily in their own internal AI capabilities. BigBear.ai must prove it can consistently win against these behemoths. Furthermore, the reliance on government spending is a perennial risk. A shift in political priorities, a government shutdown, or changes in procurement processes could all negatively impact the company's pipeline and revenue. If the company continues to post losses and burn through cash without a clear inflection point, investor patience will thin and the stock could easily retest its 52-week lows. The reality for investors is that they are not just betting on AI, they are betting on this specific company's ability to navigate the notoriously difficult and slow-moving world of government contracting while fending off giant competitors and managing its own path to profitability. In summary, the story of BigBear.ai is a classic example of the tension between a powerful market narrative and a challenging operational reality. The expectation is that of a disruptive force in the critical field of AI-driven national security. The reality, as reflected in today's stock decline to $6.80, its lack of profitability, and the significant short interest, is that of a company facing an arduous climb. The path forward is not guaranteed. Investors must look beyond the exciting headlines and scrutinize the financial statements, understand the competitive landscape, and pay close attention to the dynamics of short seller activity. The ultimate trajectory of BBAI will not be determined by the hype surrounding artificial intelligence, but by its ability to deliver tangible, profitable results in one of the world's most demanding markets.